Well, it's a 10K day out there, folks. A little bit of a sleepy one, but a record breaker nonetheless. Congratulations, everybody, hitting new all-time highs in your portfolios out there. Phenomenal to see. And the VIX is dead. Look at that VIX. It is down to 15. Unbelievable. Back in April, that VIX went over 50. An incredible move. In this video, I want to talk about many things on the reaction channel here today. One thing is, on 1000X, they posted what is the most undervalued stock in the market right now, and I answered that. I answered what my opinion is on the most undervalued big tech stock right now in the market, what the most undervalued Mag 7 stock is, what the most undervalued under $10 billion market cap, and what the most undervalued under $1 billion market cap. So I answered all those questions in this, and we'll discuss that and kind of my opinion perspectives. Then I went ahead and talked about what it would take for me to buy Tesla stock. Again, and I posted this on my X page, by the way, if you ever want to follow me on X. It's always linked in the description area of all my videos. I post quite a few things each day. But I spoke about this, 5 things that would need to happen for me to buy Tesla stock again. So we'll go ahead and talk about that and react to that in this video. Then I want to react to a bunch of little clips here, okay? First one up here is on Alphabet in Google McDougal and what's going on with their business model. Looking forward to reacting to that one. Alphabet's valuation remains highly attractive, says Evercore ISA's Mark Mahaney. So looking forward to reacting to that one, sharing my opinions and perspectives. Looks like he was just a little catching up on a little nappy before the big interview, okay? Then looking forward to reacting to this one, new home sales data that's out here today. This one from about 22 hours ago, equity markets are full steam ahead for the next 3 to 4 weeks, says New York Life Investments, Goodwin. So looking forward to reacting to that one. And the Southwest Airlines CEO went on CNBC a few hours ago and spoke about what he's seeing for demand, which I think is really important to understand what's going on with the economy. Are we seeing a bounce back? Are we not? After all the drama that happened over the spring, right? Are we starting to see a bounce back, or are things getting worse? Everything like that. So looking forward to reacting to that one. One thing only I need from you guys. Please, please, please smash a like button. That's all I need from you guys. Less than 10% of people usually do it. And I hope we can have more than 10%. If we could have more than 1 out of every 10 people just hit the like button, it would make my day. It would make my day. Additionally, if you want to be subscribed here to the channel, you can certainly subscribe to the channel. Additionally, I have a free checklist for you guys. I wanted to post my reaction channel video yesterday on the reaction channel, but my channel was having all types of issues and whatnot, so I ended up posting on the main channel. But I want to make sure you guys have access to this checklist. It's absolutely free. You can send it over via email or via text. And essentially, this is a checklist that, before I buy a stock, I like to look at all these different things and make sure, all these boxes are checked green before I buy a stock. It helps me be in a very good place. So it's free to access that. It will be pinned comment down there. And once again, can send it over via email or via text, okay? Alrighty, guys. So right off the bat here, what are the most undervalued stocks in the stock market right now, in my opinion? Well, here's what they are. In my personal opinion, for the Mag 7, the most undervalued Mag 7 stock right now is Google McDougal. Like, Google is very attractively priced. Let me show you how attractively priced the stock is. Alrighty, I pulled up 1000xstocks.com here. I want to show you Google McDougal and how attractively priced this stock is. So we're looking at a forward P on the stock of under 20 for Google, and all its growth. It's all its great numbers. It just reported a grade A income statement for this company. The numbers were phenomenal. Couldn't have been better, really, out of Google. So, I mean, I just think this stock is very, very undervalued given the growth this business model has. Now, next up here, I said for big tech, the most undervalued I can find is AMD. Now, AMD can be a little tricky. And let me show you how AMD can be a little tricky here. So if we type in AMD's ticker symbol, we're going to get a forward P of 47. Now that looks really high. And you say, wow, how could that be undervalued at a forward P of 47? That's like, we can call it like a double up of where the market in general trades at roughly for a forward P, right? Here's the thing with AMD. One, I expect their earnings per share to be far higher than where analysts are at. So the reality of that 47 forward P is not 47. It's probably about a 35 or a 37, maybe a 40 max. So that's first part. Second part is AMD's got such ridiculous growth rates, in my opinion, going on for the next several years that forward P is going to come down dramatically. And even if we're looking at analyst estimates here, which once again, I think analysts are way too bearish on AMD. I don't think I think AMD is going to blow analyst numbers out of the water. But when you look at analyst numbers, look, it goes from a trailing 12-month P of 119 down to 47 down to 26. So AMD's profitability is exploding higher. And we're going to really start to see that over the next few quarters, by the way. And so the reality is AMD is a lot cheaper than it looks on surface level here, okay? Because that earnings per share is going to absolutely be booming. Now, next up here said my most undervalued stock I can find under $10 billion is, what is it? It's cake. Cake. You know I love that cake. And so here's a deal with cake. We're looking at a stock that's trading forward P of 18, right? So we're already pretty much, under like a market multiple for this stock. But the thing with cake is I also think they're going to be much more profitable than what analysts have here. So that forward P is actually lower, in my opinion, than where it's at. But the other thing with cake is they got the next 10 plus years of growth ahead of themselves with North Italian Flour Child expansion. So the reality around cake is this stock is way too cheap given the growth trajectory of the business for the next 10 years. It's not just about AMD is more of a play on the next few years of a massive growth cycle in AI chips, right? And what they're doing with MI350 now hitting the market and MI400 next year and then the MI500 series after that. That's more of like a next, 3 to 5 year play in terms of kind of thinking about AMD. Cake, this is a whole different ballgame. Cake is really thinking about the next 10 to 15 years in growth opportunity there. So Cake's trading way too cheap here. And then the number one stock I can find, in my opinion, that's undervalued, that's under a $1 billion market cap is Honest Company, HNST. HNST is an under $1 billion company. And so for that, what I'm going to show you guys is a compare feature here on 1000xstocks.com, right? So, and if you ever want to apply for access to 1000xstocks.com, you can go to 1000xstocks.com and you can apply for access. But what I want to show you guys here is I want to show you Honest versus their peer type companies like a Kimberly-Clark, like a Procter & Gamble. And since Honest is just getting a profitability, you want to compare these companies really on a price to sales ratio basis. And so what we're going to find here is on a trailing 12-month price to sales ratio basis, Honest is trading 1.36, Procter & Gamble's trading at 4.4, and Kimberly-Clark's trading at 2.1. Now keep in mind, Honest is growing way more rapidly than Procter & Gamble and Kimberly-Clark. And it's not even honestly close. Like look at the trailing 12-month revenue growth of Honest, double digits, right? Look at the trailing 12-month revenue shrink of Procter & Gamble and the trailing 12-month revenue shrink of Kimberly-Clark. Procter & Gamble and Kimberly-Clark businesses have been literally in decline, right? While Honest is over here actually growing strong. And yet they're trading at a far cheaper price to sales ratio multiple than Procter & Gamble and Kimberly-Clark. Honest is on its way over the next few years to get into that price to sales ratio of, let's call it 2 to 4, which is where it should be long term, as long as this is a public company. Now, also, when it comes to Honest, I think it's a great buyout candidate. I think it would be a great, honestly, if Procter & Gamble, Kimberly-Clark, any of these companies were intelligent, what they would do is they would buy out Honest in the next year. The reason Honest is such an attractive acquisition target is you're getting a great brand that has many product verticals, and some of these places these other companies don't compete very strong in. Additionally, you're getting a company that now has very healthy margins and is now standing on its own 2 feet when it comes to profitability. That's very attractive. And so what you could do to scale, because what you would do with a company like Honest if another brand acquired it, is you would likely cut some staff because a lot of roles would be like duplicated roles and things like that, right? So you get more cost out of the business and the profitability of just Honest would end up increasing rapidly, essentially, okay? And the other component that I think would be very, very attractive for Honest, if a company wanted to approach them and go ahead and buy them out, is the fact that that company has one of the most pristine balance sheets of any stock you'll find under $1 billion in the entire world. They're cash loaded and they're debt free. So it doesn't get better than that. Now, what do I think, if Honest was to sell out to another company, what do I think is a fair price for Honest? I would put fair market value at Honest at somewhere between, and this is right now, like assuming, let's say somebody tried to buy Honest right now, what's the share price they would need to pay today, not 5 years from now, today? I believe anywhere between about $10.50 and about $14 is a fair price for Honest if they were to be acquired today, which is nowhere even remotely close to where that stock's trading. That stock's under $5. And I think fair market value today, if a company wanted to buy them out, would be between $10.50 and about $14. That would put their price to sales ratio more in that 2 to 4 range. Given, the growth the business has, given the now getting to profitability, you'd be able to get cost out of the business. You're getting a great balance sheet there. You're getting cash given to you for buying Honest because they're debt free and they got cash. So it's not like you got to worry about if you got to buy out another company and they're debt loaded, you're like, crap. How are we going to deal with this debt load? We're buying this company, got $500 million of debt, blah, blah, blah. It's a problem, right? Honest doesn't have that, stress free. So yeah, we'll see what happens, but Honest is definitely very, very attractively priced. No, me in regards to Tesla, I was a Tesla shareholder, obviously for a long time. It did me phenomenal, made incredible gains on the stock. Ridiculous, right? And so what would it take, and obviously now I don't own any Tesla shares, so what would it take for me to buy Tesla stock back? That's a big question, right? So I put on X, I said, these are the 5 things it would need for me to buy Tesla shares back. I said, 1, I would need to be confident they can grow automotive sales again at a 20% plus CAGR, compounding annual growth rate. If I could be confident in that, then we're talking, right? As of right now, their automotive sales are literally in decline quarter after quarter, just going down, 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 right? So 1, they need to reverse that and then start growing. If they could do that, then we can talk, and then if we talk about getting to like a 20% plus CAGR, then we're then we're looking good, right? 2, we need major valuation decompression here, okay? Which is just a fancy way of saying the stock needs to go down a lot. Because Tesla's trading at such a ridiculous valuation here, I mean, it's just absurd. Given how bad the business model is, it's absurd. The sort of, it's at a forward P 196. 196 would be completely fine for Tesla if they were growing revenues 50% plus. The fact is around Tesla, their revenues are in decline. It's not a debate, it's fact. Like their revenue was down 12% this latest quarter. Automotive was down 16%. It was a dumpster fire. And then imagine when all these energy credits get taken away. What's their profitability going to be then, right? So yeah, I mean, the stock would need to go down so much for me to even be interested in it. I said the 3rd thing is earnings per share. I need that to stabilize and consistently start growing. If that can happen, then we can talk, right? And that's a long way from that. 4, gross margins and net margins have to start consistently growing. That's a big question. Like quite have not been headed the right way, right? If gross margins and net margins can consistently start growing, then we're talking. And I said Elon has to stop, quit doing stuff to hurt the brand. He has to stop doing stuff to hurt the brand. He's done a lot. I think this company would be consistently growing if he hadn't said all the things and done all the things he's been doing the past few years, but he's done it. It's hurt the brand bad. It's reflected in their auto sales, right? Their auto sales are a disaster. They're far under what an average company's doing. And they have such phenomenal products in the market. But if you hurt the brand that bad and you make that many people mad, right? People just don't have a very good feeling around going to buy a Tesla, right? A lot of people. And so for that reason, he's got to completely reverse this. I said under $200 is okay for Tesla at this stage. Like if you can get it at like 180, 170. Under $100 is ideal for Tesla. Over 300 is a horrible risk reward for the next 2 to 3 years. So many more attractive risk reward profiles. The business has just, over the past year specifically, it's just gotten so bad. So bad over the past year. The numbers are just a disaster. What Elon's done to the brand is just a disaster. Like, up until about a year ago, Tesla still had a good chance of making things happen. But given Elon's, making so many people mad on both sides of the political party, it's been ugly, man. And their numbers have just deteriorated again and again and again. What are you gonna do? You know what I mean? The problem is it's just not showing any signs of flipping the other way. So then you have to count on robotaxi. Here's the issue. It's not as big of a market as people think. It's not. Look at Uber, right? Like Uber, you think, given how excited people are about robotaxi, you think Uber is like the biggest company in the world. No, they're not. And, you say, okay, we're eliminating the driver in the seat. Okay, that's cool. They'll make it more profitable, right? Over time, but not initially. You could lose money on that business model for years to go in the future. Ask Waymo. Tesla's like, oh no, we're just going to make money. Baloney. That's what they said a lot of times. And then they don't, right? And so Tesla will lose money in robotaxi for likely years to go in the future. People assume they're just going to like launch this thing and they're going to be making so much money. No, from what I heard, I haven't got a chance to listen to the conference call. I even heard some people on X, some of the Tesla fan folks talking about like, Tesla talking about if they have to take out debt, they'll take out debt. What? That's crazy, man. Like there's no reason Tesla should have to be taking out debt. The fact that that's even a conversation is scary, downright scary, okay? So the moral of the story is in regards to Tesla, it's just a very boring blah stock. It's not interesting at all because it's already priced in best case scenarios in so many different ways that it's just not exciting. There's just so many better opportunities out there as for investments. It's not even funny. Never mind if we end up going into a bear market in the next year or two. We go into a bear market in the next year or two, Tesla will get taken to a slaughterhouse so much more viciously than most stocks out there. It will be nasty. Google McDougal. I'm looking forward to getting this one. By the way, in Tesla, keep in mind, from the 2021 peak to the 2022 / beginning of 2023 trough, Tesla fell about 70%, folks. Keep this in mind. Tesla was in way better of a financial situation at that time. The margins were dramatically higher than they are right now. The revenue looked way better. The revenue growth looked way better. The profitability looked way better going into 2023 than it does right now. And everything's way worse. So what do you think would happen if we got a real bear market? S&P 500 went down 25, 30, 40%. To think Tesla couldn't go down another 70 to 90%. That's definitely in the realm of possibility. Google McDougal.
Capital spending forecast to $85 billion. One of the highlights of the quarter. Our Mackenzie Sagalos has more on Wall Street's reaction. Mackenzie, good morning.
Hey, good morning. Analysts liked the print, Sarah, impressed that Alphabet is still growing search and ads even as it pours money into AI. Now, as you mentioned, the company raised full-year CapEx guidance by $10 billion. Quarterly investment came in nearly 20% above estimates. And Alphabet says that it's going even higher next year. KeyBank is already floating a $100 billion estimate for 2026. And it's all part of closing the gap in the hyperscaler wars with Azure, AWS, and Meta, which says that it's building the largest compute fleet of any company. But this spend by Alphabet is backed by real demand. The cloud backlog hit $106 billion and deals over $250 million doubled year over year. Now, analysts say that Google is reinvesting from a position of strength, scaling compute faster than rivals thanks to its custom in-house chips. So yes, free cash flow fell to $5 billion, but Bernstein called the move fashionably late and welcome. And now this raises the bar for Microsoft and Amazon heading into earnings next week. Microsoft's fiscal year just wrapped up at the end of June, so we'll be looking to see if they revise up from their $80 billion CapEx spend commitment. Guys?
Yeah, well, that'll be interesting to see if the race can accelerate even from these lofty levels. I was taken by the title of this report out of Roth about Alphabet. Big G, as they call them, wants its AI crown back. And that's just a marked turn from the discussions we were having about existential risk a couple of months ago.
It absolutely is. And while Amazon is still the cloud leader, that dominance is being challenged. You have analysts noting that as enterprise AI demand grows, spend is increasingly shifting toward rivals like Google, a trend that could definitely reshape that hyperscaler landscape. And Alphabet really did deliver a standout quarter for cloud. Revenue jumped 32%. That was well above expectations and accelerating from 28% growth last quarter. Analysts see it as a major validation of Google's AI infrastructure push, especially given those rising CapEx commitments.
Right. And in the meantime, things like YouTube and Waymo kind of get lost in the shuffle. There's just so much to digest in a short period of time. Mac, appreciate that important print on Alphabet.
Yeah, so the Google numbers were an absolute banger, first off, like absolute banger. But here's a few things to factor in here in regards to Google, okay? First off, cloud business, as you talked about there, grew 30% plus in the quarter. That's amazing. YouTube looked really good as well. Search looked good, really good as well, which, by the way, search is the business everybody's so scared of. Looks very, very healthy. Everybody's using ChatGPT, no one uses Google anymore. Doesn't show in the numbers. Look at Google's revenue numbers for the search business. Better than ever, right? Listen to a conference call in regards to all the data they give in regards to search business. Looks better than ever. So all that talk is just talk. Waymo, this is why, it's going to be really brutal for anybody to compete against Google really in this market, because they have so many businesses that just throw off so much cash. And I don't even think that the thing for Google is they don't even care if they lose money in that business for years to go in the future. Tesla, on the other hand, if we're talking about the robotaxi network, they've got to make money, because they don't have cash cow businesses like Google does. Google has a search business, which is a cash cow. They have YouTube, which is a cash cow. And the cloud business, which is a cash cow. Right? They got all these cash cow businesses just throw off insane profits, right? Tens of billions of dollars. Incredible. And the profits are just building. Tesla's moving the other way. So Tesla's going to have to try to make money. Well, what do you think Google's going to do? They're probably going to undercut price again and again and again, because they can do that. They've got the money to do that. They got arguably the best balance sheet in the world, or certainly one of the best balance sheets in the world. All those profits is nothing for them. There's nothing for them to just invest aggressively. And also remember, what is Google? Google's a data company. They're going to make so much money off the data, and they're set. And so, people got to play these games out on a higher level here. And when you begin to play it out, you're like, shit, man, good luck competing against Google. Remember, I used to be a Tesla shareholder. I used to look at the robotaxi opportunity and everything, and then I started to understand kind of what Waymo was up to, what they had in the market for a product, how it was expanding. I started to see oh man, they are not going to really actually need to make money from this, whereas Tesla's core business is declining. They actually need to make money from this. That's not a position of power, man. That's a brutal place to be. All right, next one up here.
Internet research, he raised his price target on Alphabet to $240 a share from $205. I think the concern and anxiety around this stock has been this idea that ChatGPT and Claude and all the other big LLMs were somehow going to take market share from Google. Google's saying, we're not going to have it, and we're actually doing better than you thought. Did that surprise you?
I like how you set it up, Andrew. I think you just took all my thunder there.
Sorry. Sorry.
That's okay. This has been and remains our top pick in large cap internet. It's still trading at 18 times earnings, so it's trading at 7 multiple points cheaper than Meta, and it's still at a slight discount to the market. For the search leader, the YouTube, the company that owns YouTube Cloud has got this Waymo asset. I still think it's the valuation is highly attractive. Fundamentals came in better than expected, and expectations were rising. I think there's two kind of broader things the three things that are happening here. First is the ad market is kind of held in better than we all feared 3 months ago. Second, cloud market just continues to get stronger with all of this AI, generative AI demand. And then third, Google is just executing well. Give them credit for it. They're at record operating margins, even though depreciation is rising because of this big CapEx cycle. They've been very consistently managing down or flattish their headcount. And so they're showing a lot of cost discipline. I think the story is just getting stronger, and continue to like the stock.
How much of it is Gemini getting better? I think there was a view at another point in the ballgame, maybe just a couple months ago, that ChatGPT had so far outpaced where Gemini was. And I've always thought the sleeping giant here is Google, because if they're able to productize what's inside of Gemini so that it works inside of Google and Google Calendar and all of the different products, all of a sudden it becomes super powerful given the data that they have. That has yet to be unleashed.
I agree with your setup on that too. We should change roles here, Andrew. I think you got that. I think you got that right. I think the two things that were sort of lost a little bit in all this debate about what was going to happen to Google and ChatGPT and Claude and Google search getting displaced is one, Google has this mountain of data. They've got a bigger mountain of data than anybody else with which to train, Gen AI to come up with better solutions, both on the advertiser side and on the consumer side. The second thing is this company, Google, it's not like they've been asleep at the switch here. I mean, they've been investing aggressively and talking about Gen AI for a decade. I remember watching Sundar Pichai's first Google I/O presentation about a decade ago, may have been 9 years ago, and his topic was AI. So it's the company was there. They just needed a little bit of a kick, to get going. And I think that's ChatGPT did them a service, I think, in some ways, and forced them to innovate faster. And I think they have innovated faster.
What do you think of all the CapEx spending? The market doesn't seem to be upset about it. They seem to be quite happy about it. I just wonder whether the economics of all this CapEx spending, when you start to see it meaningfully kick in, given just how high a cost all of this really is.
The basic question is there an ROAI? Are these companies like Microsoft and Amazon, Meta and Google, are they going to get a return on, what's going across the board, 250 billion in CapEx? Now, not all of that obviously is going to generative AI, but a huge chunk of it is. And there's some decent data points that have come out. I mean, Google's P&L probably gives you some data points. Meta's had a slew of them. We expect to hear more next week about how it's helped them do better recommendations, both for consumers. So the content's gotten more relevant, more personal, and people are engaging more. I mean, that's factually true. And on the advertiser side, advertisers feel that they're seeing a better return on their ad spend because they're able to, their ads are being targeted at the more accurately at people at the right time or the most actionable time, and they're seeing conversion rates rise. So there is evidence. Whether you're really going to get a great return on all of that spend, I don't know, but you are seeing a return.
Yeah, so what does all this spend mean in the end for AMD? It means very good things. It means very good things. All these companies are continuing to remain very committed to their spend, right? And a lot of this CapEx you keep hearing about, this capital expenditures, is going to go to companies like NVIDIA, and it's going to go to companies like AMD. AMD is going to be the one that really picks up a lot of share and a lot of percentage growth over this next few years from all this spend, essentially. But it's going to benefit NVIDIA as well, no doubt, right? Like both companies benefit. AMD is just going to benefit more from it in the end because they haven't really benefited the way NVIDIA has over the past few years. But, when it comes to AMD, the stock's not up 107% by accident, the past few months. Like this is about a 3.5 month chart here for AMD. It's not up 107% by accident. It's because everybody knows now AMD is the new hottest play in town when it comes to the AI cycle. And the stock is absolutely decimating NVIDIA now at this point in time recently. Look at this. Look at this outperformance, guys. I told you this was going to happen. It's not that NVIDIA is doomed. That's the thing. It's not like NVIDIA is doomed. And this is what I've always explained. Like NVIDIA can do just fine. But AMD is the play for the next few years. AMD is going to significantly outperform NVIDIA. And as time goes, you're going to see this gap from basically those April lows. You're going to see it widen more. Like you'll eventually be at a place where AMD will be up like 200% from those lows, and like NVIDIA will be up like 100% or 110% or something like that, which is still really good for NVIDIA. Like good, like that's still great returns. It's just going to get trounced by AMD. And then if we fast forward 3 years to the future, from those April lows, don't be surprised if AMD then is up like 400 or 500%, and NVIDIA could be up 100 or 200% from those April lows, right? But there's a big difference between making 400 or 500% on a stock versus 100 or 200% on a stock. So that's what we're witnessing. That's what we're starting to see play out. And it's just getting more and more pronounced. But we're still early in regards to move. Like, wait to see the guide from AMD. I think the guide's going to be the thing that's going to knock people over and be like, oh my gosh. Like, people that are still like iffy about AMD and like, I don't know. I feel more comfortable in NVIDIA. After you hear that guidance in the conference call, that's going to be the thing, in my opinion, that starts to wake people up really. Wait, what? And then we're going to start talking about AMD taking out all-time highs of like 210 or so. And then we'll be off to the races, 222 do-si-do, and it's going to be a lot of fun. So anyways, that's just a whole game that's got to play out. Let's talk some home building.
Our June new home sales, expecting a nice round number around 650,000 seasonally adjusted annualized units. Comes in on the light side, no surprise, 627,000, but it is from a 623,000, so it is up just a smidge, somewhere around 0.5%. But here's the deal. Last month, 623,000 was the lowest in 7 months, going to October of last year. This is barely above that. It still comps to that. The previous month was a much more robust 722,000. So we have back-to-back weak months, and we know the story. Journal talks about how the spring shopping season was very weak. We're seeing inventory still building on a number of fronts with regard to new homes. And on the existing, well, we see that there's weakness there. Rates remain persistently high, and even if the Fed lowers, there's no guarantees what the 10-year is going to do. But I will say, if you look at the 2s10 spread, it's been hovering around 50 basis points, not much wiggle in the curve. That's because of the Fed meeting next week. Sarah, back to you.
Okay, thank you, Rick. Rick Santelli.
So what does this mean for the economy? You know, you see a home number come in worse than expected there, right? Does it mean a lot for the stock market? I mean, not really. S&P 500 still green today. Nasdaq still green. Russell is down. But, people look at the Nasdaq and the S&P 500 as dominated by what? The biggest stocks in the stock market, right? It's dominated by NVIDIA, Meta, Google McDougal, Apple, all these big stocks. So people are like, okay, home building numbers came in worse than expected. Who cares? Listen, man, in regards to what this means for the economy, this could be very scary. Listen. These home building numbers, in terms of these sales numbers, keep coming in worse and worse and worse. You will start to have a very negative effect on the economy. I would say in probably like mid 2026, going in that could stay until 2027. We've got to get these home building numbers better. If they continue to weaken, that's not going to be good for the economy. It's going to be very bad. I'm one that stands by the fact that I believe the most important thing to ever happen in the U.S. economy is a new home gets built. There's nothing that's that impactful, in my opinion. The amount of direct and indirect jobs that come from one home being built. And if you ever built a home, you ever had a home built for you, or you ever been involved in anything home building related, you know exactly what I'm talking about. The amount of people and trades that make money off of one home being built is ridiculous. From the cabinets to the flooring to the guy that has to do the walls and the wood and the roofers and people that pour the slabs. I mean, it's insane. And then all the landscaping that needs to be done, right? All the furniture that's sold for that it's incredible what it means to the U.S. economy. So, moral of the story is, if those numbers continue to weaken, it's not going to be good, man. It's not going to be good for the economy, and that is something that definitely scares me. Come next year or even into 2027, we've got to get these numbers better, or we're going to have big problems in the job market. But it's not to the level yet you can make you can't make a justification on either way yet. Yeah, keeps getting worse and worse and worse. Then we could be talking.
Nice to see you.
So good to be here.
You're cautious.
Right now, my ears are just kind of perked up. I'm just looking. I'm like, I don't like what I see over there, but I'm not sure it's bad yet. Give me a few more months of bad home numbers, I'll start to get very concerned.
On the recovery, even though the trend and the momentum feels like it's going one way.
Yeah, that's absolutely. I agree with that.
Why are you cautious?
So the next 3-4 weeks, I think, are full steam ahead for the equity market in particular, and that's because not only has Q2 economic reality been much better than analysts were expecting at the beginning of quarter. Just many of the worst case scenario risks have not materialized and are not likely to materialize over the next few weeks. So earnings are likely to be quite strong. Again. But the backdrop, as well as we think ahead, related to deregulation, related to the sort of supply chain reglobalization that's happening, supporting the AI supply chain in particular, that's supportive of market broadening as well. And we've seen some of that breadth. Even in weaker market days, you haven't seen a big rotation into defensives. And so I think that the market will continue to climb this wall of worry in the near term. What I'm worried about is that those great financial conditions, the tariff risks that I do believe will start to manifest in the economic data over the next couple of quarters, and a key risk for the market with respect to immigration and the labor market, those are still interest rate related dynamics that the market's going to have to grapple with.
Aren't we incrementally knocking the wall of worry down? Like, we were climbing the wall of worry when we were worried about inflation. Don't really have a problem with that. When we were worried about the tariffs being larger than they appear they're going to be, we don't really have a problem with that. We were climbing the wall of worry when we worried that earnings were going to be less robust than they've been. I feel like the wall's going in the other way, not up. I mean, we have more concerns to really worry about. It feels like it's not the case.
I think the wall of worry has been effectively addressed and resolved for now. What we're worried about is more a matter of timing, and isn't that always the case for the market? So I'll take your ideas one by one. Inflation. We are starting to see inflation creep into the economic data in June's data. I expect that to accelerate in Q3 and into Q4 because new ordering, holiday ordering, has only just started to happen. The backlog of inventories that companies had before tariff risks began to materialize, that's starting to be cleared. So that risk is still ahead of us. Importantly, immigration and sort of the tightening of the labor market, especially from the supply side, is a risk I think the market actually isn't in the wall of worry, but is an element that's going to impact the sort of interest rate sensitivity of the market moving into the second half of the year. It's not an overly bearish view on the U.S. economy, and in near term, it's actually quite a bullish view on the market. But as those risks start to materialize in the economic data, I think we'll see a rates response.
Well, you'll see a rate cut response. That's part.
No. So
You don't think the Fed's going to cut rates this year?
I think the Fed might cut rates one time this year. And the reason look, when it comes to the inflation and labor market data that we've had so far this year, I think the Fed might have cut already twice this year. But the policy risks on sort of the path ahead are top of mind, and those are what I expect to materialize over the second half.
But the inflation fears, certainly the most severe ones, haven't really materialized. And Powell himself has suggested that they would have already cut if not for the tariffs. So if you continue to go in that track of deals on trade, tariffs, not that big of a problem, not like people expected, why wouldn't they cut?
So here's the three reasons why I think it's difficult for them to cut assertively into the second half of the year, even though I completely agree that the data so far suggests that they would otherwise be. The first is that tariff rates are higher than they used to be, but probably more importantly, I think moderate tariffs are actually more inflationary than really severe tariffs. Because if you have really severe tariffs, then you have demand destruction. It's really difficult for companies to operate their supply chains. That's not what we see here. We see a muddle through scenario where companies are going to be so far passing on higher costs or in some cases taking hits to margin. That just hasn't materialized yet, but I do expect it to. The second reason I think it's really difficult for the Fed to cut is that tightening labor supply means the unemployment rate is going to actually be moving lower into the second half of this year, and I think that's an underappreciated risk. And the third is just financial conditions are so easy. Equity markets have been doing good. Credit spreads are tight. If you want to borrow, you can. There's really nothing pointing from a financial markets perspective that the Fed assertively needs to be cutting rates right now. And so I think that they will stay on hold for as long as possible.
So, it's such a tough situation. You know, do I think the Fed should cut in September? Absolutely. Without question. They should be cutting. Absolutely. You know, CPI has been trending in the twos for a while now. And we got a Fed funds around 4.5 or so, roughly, right? You know, you can't have a Fed funds up there when you consistently, month after month after month, have a CPI in the twos. Doesn't mean they have to lower to zero, but get the Fed funds rate down more into a range around where CPI is at. That would be a balanced view. That'd be a balanced market. Get the Fed funds rate down to about 3%. Boom. You know, they need to cut about 150 basis points roughly off the Fed funds rate. Make it happen. Get it done. Get it done sooner rather than later. and then we can be done with all that, right? And then you'll see what happens with the economy or what doesn't happen with it. But the problem is the Fed's not going to do that. The problem is the Fed is this disillusioned like way of thinking about. They wait till it's so bad that they have to move. That's the issue. They wait till it's so bad that they have to move. 2022, great example of that. They waited till inflation was so insanely out of control to finally start moving up. I mean, by the time they started moving up rates, inflation was long gone. It was like the worst we had seen in decades and decades and decades and decades. Like they waited till the last second. Look at the great financial crisis until they really started cutting. They didn't start really cutting until it was so obvious. It was awful. And the economy was doomed that then they finally started really cutting like crazy. Like they wait so long in regards to these matters, man. And they're doing the same thing again. Southwest CEO.
This is, look, your stock is down almost 10% when you miss on the top and the bottom line, and then you have guidance the way you do. What are you seeing in the economy right now?
Well, first I want to say a shout out. Our folks in the Network Ops Center, they do an awesome job running this airline every day despite weather. But so just got to say thank you to this team. But, demand was really tough. So we slipped about 6% from the beginning of the year, against what we thought. The nice thing is in the second quarter, demand stabilized on the domestic side. In the last month or so, we have seen the beginning of an inflection back. Again, it's just the macro uncertainty, I think, that drove that. But again, the good signs is we're seeing positivity now.
What happened?
Push back against that. I think the whole bag change, I think that matters significantly. As somebody that used to fly Southwest Air pretty much only. I used to only fly Southwest. I switched over the past year. Now I fly Delta, American, and other ones because, the whole bag change and whatnot, like
with basic economy, when you rolled that out,
like they're basically Southwest is basically transforming themselves into just another airline, like all the other airlines, like United and American and Delta and all the others. So I mean, if they're going to change the airline from their old seating arrangement way of doing it, from their old baggage policy and whatnot, well, now you're just going to get thrown in with all the others, right? So, because now there's really nothing that, in my mind at least, differentiates them versus all the other guys.
You even mentioned it in your earnings release that you saw a slip in terms of bookings and revenue.
Yeah, it was really the mechanics of this new product. So it has new restrictions, and it, the literal booking flow, you have a checkbox that you have to click. So it was really the friction in the process. So our folks went to work, and they attacked the digital flows, and that was all cleaned up in 2 weeks, and that impact was gone very quickly.
Given the weakness we're seeing in the broader macro economy, and even though you're seeing stabilization now, do you need to cut even more capacity in the second half?
We've been the leader in managing capacity here. We've taken another 1.5 points out of the back half of the year. This year we'll only grow about 1 point. But really the issue is getting the demand back, and we are beginning to see the demand strength come back to domestic and volume. And so I'm optimistic that we're seeing a return to travel here in the United States.
So you think from here on out, to a certain extent, even that basic economy traveler, the weakness has already, it's built in. From here, it stabilizes.
Well, after we made the changes on the basic economy, really the booking flows, we've seen stable demand. We've seen the conversion rates return to prior or actually a little bit above. So we're seeing a return of the volume and the bookings. Now, you are having to do more promotions than typical. You're rarely on sale in the summer, and really every carrier has been on sale this summer.
You are at the same time, as a company, buying back $2 billion worth of shares. Is this the right time to be doing that, given the challenges you're facing?
Well, we just completed the $2.5 billion buyback that was set forth in September of last year. We finished that $1.5 billion up in the second quarter. The Board of Directors approved an additional $2 billion share repurchase, but it's over 2 years. We have terrific initiatives in place. Things like bag fees that came online. They're expected to generate $350 million in EBIT this year and a run rate of about $1 billion a year. So we think that the earnings power is going to inflect quickly, which is why we put a 2-year time frame on that $2 billion buyback.
How is assigned seating as you look at when you look at what starts in January? What's your sense in terms of how your customer is going to respond?
Well, what I love is that, consumers want this. So more than 80% of our customers, 85% of customers that don't fly Southwest Airlines want assigned seating. They want extra legroom options. The great news is we've been able to pull that up, and actually it goes on sale next week, July the 29th. And I think we're going to do very well. And then it's for flights that operate in January of next year. But I'm excited that technology is done, and we're ready to start selling assigned seats.
But you're still cutting that guidance, though, for the full year, right?
Well, if you look at the full year, we set out a guide of $1.7 billion in EBIT, and the difference is just the macro. That $1 billion.
That's a lot of macro, though, Bob.
It is, but it's the same 5% that you've seen. Really, every other domestic carrier report, they've seen a 5% drop in demand, and that's that. Again, the good thing is that we've seen it inflect back, and what I love is that we've got a set of strategic initiatives that are unique to Southwest Airlines. So we have the opportunity to outperform. Those initiatives are on track. They're on track from a timing perspective. They're on track from a financial perspective. We're going to deliver, and you're going to see an inflection in the earnings power.
Bob, thank you very much. Bob Jordan,
thank you.
CEO of Southwest Airlines. Guys, we'll send it back to you.
So, what's my take on that Southwest CEO interview there? Two things. One, good to hear demand's coming back. That could be bullish the economy. Obviously can't get too excited about that, but if, you see more and more travel, more and more demand for flights, things like that, it's always bullish the economy, right? Second, that man sounded like, I'm not sure about his business model. I'm just going to be completely honest with you guys. Like, I would not touch that stock. It just doesn't interest me at all. Like, I don't know. They've lost core loyal customers like me that, I wouldn't even look to any other airline all the years. I would just, what Southwest got, and I would be confident that their pricing was attractive. They had the whole, free bag, bags fly free, all that stuff. Like, I was a very loyal Southwest customer for the longest time, and I've switched now, right? And now I'm like, I don't care who, we fly on Delta, American, United, and whatever. If it's Southwest, it's Southwest. It doesn't matter to me anymore. So I'm worried that they're going to have lost a lot of loyal customers because Southwest was very differentiated, and now it's just going to feel like another airline, which now you just commoditize yourself. You know what I mean? Like, that's no fun. That's certainly no fun, when you commoditize yourself like that. So we'll see how it all shakes out. But yeah, the problem is with a lot of CEOs, especially if they're not like founder CEOs, they'll run the numbers, right? And they're like, if we do this thing, it's going to drive $350 million EBITDA. Earnings before interest, taxes, blah, blah, blah. Okay. Does it actually work like that in the real world? And that's where if you're a founder, you actually started businesses, you ran businesses from the ground up, you have a little bit better intuition around these things. You're still not going to be perfect, but you have better intuition. And you might run numbers and be like, that's dumb. Like, we shouldn't do that. That's going to hurt our business long term, making this blah, blah, blah move. Like, yeah, we can make money off in the short term, but it's not going to help us over the next 5-10 years. It might help us over the next 1 to 2 years. This isn't going to help us. It's going to, we're going to get tons of hate. We're going to get tons of complaining from a lot of our loyal customers, blah, blah, blah. So that's the issue you run into with a lot of these businesses. And that's why a lot of times founder-led companies are just easier investments because they're less likely to make some decisions that you're like, what? Like, they're going to do what? Because, the math says do this. Math could say a lot of things, right? Steve Wynn was always great at, obviously building insanely high-end resorts. And he would spend fortunes of money on some things that, other companies weren't willing to do, right? And he was willing to have the cleanliness of the property be at certain levels. And he was willing to spend, if he had to spend $1 million on a chandelier, somebody else would be like, what's $1 million on a chandelier? That's stupid. Like, we'll spend like $10K on a chandelier. Like, what is he doing, right? But rich people notice all these little fancy things here and fancy things there, right? And those rich people come with a lot of money, and they gamble a lot of money. And so, he was just very of the understanding of doing these sorts of things that, on a financial, if you're just running the numbers, your bean counter, you're going to say, this is dumb. Like, we can't do this. Like, what? And he would be able to look at it and be like, no, we are going to do that because, we're going to spend on this thing, but it's going to generate us way more money than what you think, And so, the math, it's not all that matters in business, as it's not the only thing that matters in investing. Math matters. It matters in stocks. It matters in business, but it's not the only thing that matters. A lot of business and investing goes back to heart, goes back to guts, and goes back to belief, faith. It goes deeper than just math. Math is a component of it. And if you just get wrapped up in only math, you're going to end up in some problems, okay? Hope you guys enjoyed today's video. As always, appreciate you joining me, including that little tidbit there at the end. Pin comment down there, my free checklist before you buy stock. Make sure you guys get access to that. I probably won't shout that out for quite a while, so make sure you guys get access to that today. That will be pinned comment. Much love and have a great day.